The first step we'll need to complete to perform our discounted cash flow analysis of Evergreen Lawn Services is to model out forecasted after-tax free cash flows for the business. This step and others in our discounted cash flow analysis will require a significant amount of judgment on our part and is clearly subject to our estimations. But fundamentally, the price we're willing to pay for a business will be based on the ability of that business to generate free cash flow in the future. So this is a very important step as we analyze our potential acquisition. Now, I don't want to get too lost in the weeds on building this forecast from the ground up. As I said, the inputs and assumptions we use are subject to significant estimation. And I certainly don't want to present this as the one single way to model out cash flows. In fact, the level of skill a company has when it comes to estimating the potential cash flows of an acquisition plays a large role in whether the acquisition is successful at adding value or not. So all this to say, I've put together a fairly simple model we'll use in our analysis, and we'll walk through it together now. In the end, what we're really interested in is the series of free cash flow that we believe this business can produce, which we can then in turn use in our discounted cash flow calculations. So here is the free cash flow model we'll be using in this series. Let's walk through it step by step so we have a strong understanding of it, and we also have it available for download if you'd like to take a deeper look on your own time. So to begin, at the top here we have the different inputs and assumptions we'll use to help populate our model, and we'll touch on each as we come across them. Then our cash flow model begins on line 24 here, and you can see the first thing we're going to do is model out our P&L. In the first three columns, we've populated the past 3 years of data at the account level. And then on the right-hand side of the divider, we'll be forecasting the information forward for 5 years. Which does raise an immediate question. Why 5 years? Well, it's really up to you how many years to include in your model. And in some cases, it may be driven by the plans you have for the acquisition. Let's say as a management team, you've concluded that if acquired, you could run this business at a higher profit margin. Well, maybe your plan is to purchase it now, implement your strategy over a couple of years, run it at that higher margin for a year, and then sell it. So your entire time horizon is 3 years. In that case, you'd want your model to match that, and you'd likely include a 3-year forecast instead of a 5-year forecast. But we'll assume that our plan is to hold and operate the business long term as a going concern. In that case, there's nothing stopping us from modeling 3 years, 5 years, 6 years, 10 years, really whatever we feel is best. However, the further in the future we try to forecast, the more difficult and unreliable our estimates will become. In practice, 5 to 10 years is fairly common, with 5 being a nice combination of enough detail to make the exercise valuable, while at the same time not introducing so much uncertainty as to make it unreliable. And in any case, as we'll see going forward, our analysis will include a terminal value, so the number of years we include won't change the underlying mechanics of the calculations. So that was a long explanation to say that our model will include 5 years of estimated cash flows. So turning back to the model, you can see we begin with revenue, and we're calculating that very simply as a year-over-year increase or decrease. So our formula here is to take the prior year revenue and link back to our assumption for year-over-year growth in our inputs above. Then for our gross profit, we simplified this quite a bit, and instead of forecasting each individual account, we've simply estimated a gross profit percentage we feel the company can achieve under our management. You can see the gross profit percentage has slowly decreased over the last 3 years, and we're estimating that it will continue to do so in the first year after acquisition, before rebounding back to 61%. And our gross profit is then calculated as the gross profit percentage multiplied by our revenue, and then we back into our total cost of services from there. Then for our operating expenses, we performed a zero-based analysis of what the administrative salary structure would look like under our management. You can see Evergreen provided us with this 2025 payroll summary. And while we're not interested in the hourly calculations, as that will be captured in our gross profit percentage estimation, we did perform our own analysis of the admin salaries. You can see that here, and while the president, operations manager, account manager, and receptionist all remain, we are planning a bit of a shakeup to the accounting team. Presumably, we have these functions at our own company right now, and we feel we can lower the administrative costs at the target company by allocating some of our existing employees to the accounting functions instead of multiple full-time people dedicated entirely to Evergreen. Then we have these assumptions for the year-over-year growth of these salaries. You can see in year 1, we expect a 3.5% increase from the 2025 base year. Year 2, we estimate a 3.25% increase over year 1, and then we estimate 3% annual wage increases thereafter. So we've linked those totals back to our forecast P&L. You can see in the first year under our ownership, the administrative salaries are forecast to decrease by 5.24%, despite the assumption that individual salaries will increase by 3.5%, and this is due to the reduction in headcount we just discussed. Then in our assumptions above, we have an estimation for payroll tax and benefits as a percentage of payroll. And presumably, we should have some solid data for that, given that we can analyze our own existing admin cost structure to estimate it. Then after payroll, we calculate the rest of our operating expenses very simply by lumping them all together and including an input above to estimate the year-over-year growth of our non-payroll operating expenses. Then we get to our other expenses, including depreciation and interest. We'll discuss interest in a bit, but first let's think about depreciation. It is important that we include this, as we're interested in our after-tax cash flows, and we're able to deduct depreciation when calculating taxable income. But to calculate depreciation, we need to forecast our capital expenditures. And we'll also need those forecasted capital expenditures later in our model, so let's look at our forecast now. First, you can see we received as part of our due diligence a PP&E schedule from Evergreen. We've then used this as a basis to forecast capital expenditures in the future. So for example, I have all computer hardware organized in this first section here. We have the historical purchases and forecasted future depreciation for those items, along with forecasted expenditures for the next 5 years. And for the forecast, we're assuming that on average we purchase our new equipment in the middle of each year on July 1st. The cost each year is based on these inputs above for change, though in this case not year over year, but instead from the base amount in 2025. So we're expecting to continue purchasing computer hardware for the next 5 years, growing 3% each year. It's a similar story for equipment. General growth with a small lull in year 3. But for our furniture, we expect we won't need any additional office furniture for the next 3 years. But then beginning in year 4, either from growth or obsolescence, we'll again begin purchasing some new office furniture. So this all leads us to estimated capital expenditures each year for the next 5 years, which we've in turn used to forecast our depreciation expense. And that forecasted depreciation expense is populated on our forecasted P&L in our 5-year cash flow model. Then for interest, we'll assume this is interest on debt financing. And as you can see, Evergreen has carried very little debt and paid very little interest in the past. Our assumption is that we will include more debt in the capital structure, so our interest expense will grow accordingly. And these are hard-coded figures from our interest expense input at the top here. But as we'll see in a moment, interest on debt will not actually be included in our forecasted cash flows. We'll remove it down below in a minute. The reason for this is that in the first step, we're interested in the free cash flow of the operating business. regardless of the structure we plan to put in place to finance it. We might plan to pay down all debt at the company and finance the entire business through shareholders' equity, in which case our interest expense would be zero. Or we may plan to add significant leverage, and in turn plan to pay a significant amount of interest. But what we're interested in for our analysis here is the free cash flow that the operating business is able to produce, regardless of how management chooses to structure the capital. So whether the interest is $0 annually or $1 million annually, it doesn't matter in our estimation of free cash flow. It will come into play later as we look at our discount rate, but that's a discussion for a future episode. For now, we're interested in the unlevered free cash flow this business can produce. So our interest expense here is largely irrelevant at this point. So at this point, we have all the information we need to forecast our net income. And then you can see we begin to modify our net income to calculate our unlevered free cash flow. And to the point I just made about interest expense, you can see the first thing we do is add our interest expense right back to our net income. Also recall that because Evergreen is a pass-through entity for tax purposes, this net income figure is effectively pre-tax, so we only need to add back interest to get our earnings before interest and taxes. From there, we calculate our after-tax income. We do this by assuming a tax rate of 21%. But this would be adjusted based on your own company's estimated tax rate. Then after we have our after-tax income, we add back our non-cash expenses, which in our case is only our depreciation, which we estimated earlier. And then our final two steps are to subtract our estimated capital expenditures and our estimated change in working capital. We looked at our capital expenditures earlier, but just to briefly touch on our working capital, we've estimated that in its own worksheet here. We're using the historical balance sheets provided to us by Evergreen for the prior 3 years to calculate a typical working capital as a percentage of revenue. And then we're very simply averaging the 3 years and calculating a working capital requirement based on our forecasted revenue. Since our working capital requirements are growing a bit each year, we'll have to tie up more cash in working capital, and that leads to a decrease in our unlevered free cash flow. So after all that, we've calculated our unlevered free cash flow like this. Our earnings before interest and tax multiplied by 1 less our tax rate, plus our non-cash expenses like depreciation, less our forecasted capital expenditures, less the change in our working capital requirements. And after all that, we finally have at the bottom the figures we're interested in, our unlevered free cash flow forecast for the next 5 years. So again, this isn't meant to be a course on free cash flow modeling, but I did feel it important to provide some context behind the cash flows we've calculated. In the end though, for our work on the discounted cash flow analysis, we're really only focused on this final line here. This is a series of cash flows like any other we've looked at in this course. And at this point, we need to determine the present value of those future cash flows. Before we do so though, we'll need one all-important variable to that calculation, the discount rate to use. So in the next episode, let's begin to discuss our cost of capital and formulate the interest rate for our analysis.